What if the number flashing on your screen is not the full story? Not because of a rounding error, not because of a delayed data feed, but because the system producing that number operates under rules most participants never examine. This week, during live trading hours, the largest futures exchange in the world, CME Group, went dark in its metals complex for roughly 90 minutes. No bids, no asks, no price discovery. When trading resumed, silver fell $3 in minutes. At the exact same time in Shanghai, buyers were paying the equivalent of $101 per ounce for physical silver, while Western futures traded near $89. That is not a minor discrepancy, it is a structural divergence. Tonight, we are not predicting price, we are examining systems. Most observers were given a simple explanation. CME cited technical issues. Exchanges are complex. Infrastructure fails. Risk protocols trigger automatically. Orders are canceled to protect participants during extended outages. On reopening, silver's drop was framed as a mechanical stop-loss cascade, a normal consequence of leverage meeting volatility in a thin order book. That explanation is coherent, but it is incomplete, because this was the second significant disruption at CME in less than a month. Earlier in February, settlement prices across multiple contracts were delayed, requiring manual reconciliation. Now, less than 3 weeks later, a 90-minute halt in metals and natural gas, with metals taking far longer to restore. Timing matters. The halt occurred as silver approached a key resistance level near 92. It occurred 48 hours before March settlement, and it occurred while registered silver inventories on COMEX were declining steadily. When the market reopened, every day order and every good-till-date order had been canceled. Only previously acknowledged good-till-canceled orders remained. In practical terms, the order book was wiped clean. In a freshly emptied order book, participants with collocated servers and algorithmic execution systems can repopulate liquidity in milliseconds. Retail traders cannot. This is not accusation. It is structural observation, and structure is where we turn next. Modern precious metals markets are built on a layered system. Physical metal at the base, derivative contracts on top, and clearing infrastructure governing the relationship between the two. The COMEX, a division of CME, has long been the primary venue for global silver price discovery, but history reminds us that futures markets can experience stress when physical demand collides with leveraged positioning. In November 2021, CME halted silver trading for approximately 10 hours, officially citing cooling system issues. The halt coincided with first notice day for December contracts. At that time, registered inventory was already under scrutiny. When trading resumed, volatility intensified. The halt itself did not cause the move, but it occurred during conditions of elevated delivery sensitivity. Go back further, and similar tensions appear in different forms. The Hunt brothers episode in 1980, the liquidity stresses of 2008, the physical retail surge of 2020. Each episode is different in cause, but the common denominator is simple. When confidence in the paper-to-physical conversion mechanism weakens, volatility increases. This week's halt must be evaluated within that historical lens. According to COMEX vault data, registered silver, metal specifically designated and available for delivery, has declined to approximately 86.3 million ounces. In a single day, 2.2 million ounces shifted, with a net reduction of roughly 890,000 ounces from registered status across vault operators, including HSBC and JP Morgan. Registered is not the same as eligible. Eligible metal is stored in vaults but not committed to delivery. It belongs to someone. It cannot be assumed available unless converted to registered status. That distinction is not academic. It defines delivery capacity. At the same time, 71 million ounces of March silver contracts were rolled forward into later months, the largest one-day roll observed in this cycle. On the surface, that relieves immediate pressure. Obligations are deferred, but no equivalent influx of newly registered metal accompanied that roll. Deferred obligation is not eliminated obligation. Silver is not merely a monetary metal, it is a critical industrial input in photovoltaics, electronics, medical applications, and high-conductivity components. Industrial demand is relatively inelastic. It does not disappear because futures prices decline $3. Unlike gold, which is largely held for monetary or investment purposes, silver's consumption profile creates ongoing physical drawdown. In that context, persistent declines in registered inventory become structurally relevant. Mexico remains the world's largest silver producer. Security challenges, cartel-related disruptions, and infrastructure stress in mining regions introduce operational uncertainty. Even modest production interruptions ripple through a supply chain that already operates with limited buffer relative to paper positioning. Meanwhile, on the other side of the world, the Shanghai Futures Exchange suspended 25 trading groups in February for position limit violations, an unusually high enforcement action count in a single month. Enforcement intensity often increases when concentrated positions threaten market stability. Again, this is not a conclusion, it is a signal. Open interest in COMEX silver has been declining, while the largest silver-backed ETF, iShares Silver Trust, has recorded consistent inflows. Futures are capital efficient, ETFs are not. Choosing the ETF structure over futures suggests a preference for fully allocated exposure over leveraged derivative exposure. When market participants migrate from derivatives toward asset-backed vehicles, it can reflect a subtle shift in trust. Trust deficits in leverage markets do not resolve through rhetoric. They resolve through structural adjustment. While Western futures traded near $89, Shanghai spot silver traded near $101, and Shanghai futures near $106. That creates a premium of roughly $12 to $17 per ounce, depending on contract comparison. Crucially, that premium widened during the Western sell-off. If the Western drop reflected new global information, one might expect convergence. Instead, divergence persisted. Persistent regional premium suggests either currency, capital controls, or localized demand pressure. It does not automatically imply manipulation, but it does imply structural separation. And when price discovery fractures geographically, the concept of a single global price becomes more complex. The February gold contract, normally nearly closed by this stage of the cycle, reportedly shows approximately 4,000 open contracts still outstanding. That represents roughly 12 metric tons of gold, or around $2 billion in value. In isolation, open interest late in delivery month is not unprecedented. But in combination with declining silver registered inventories, elevated Shanghai premiums, and repeated exchange disruptions, it becomes part of a broader mosaic. Markets rarely signal stress with a single indicator. They signal through clusters. Markets are not just mathematics, they are belief systems. Participants believe that futures contracts convert to physical if required. They believe exchange infrastructure is neutral and resilient. They believe price is a fair reflection of supply and demand. When halts occur near critical levels, when order books are cleared, when premiums widen across continents, belief is tested. History shows that price volatility accelerates when confidence erodes, not because of conspiracy, but because leverage amplifies doubt. A halt breaks momentum. A cleared order book resets positioning. A sharp reopening move clears stops and redistributes risk. These are mechanical realities of modern electronic markets. The question is not whether such mechanisms exist. The question is whether underlying conditions required them. This is not a prediction of imminent explosion. It is not a claim of guaranteed shortage. It is not financial advice. It is an examination of structure. Registered silver is declining. Delivery obligations have been deferred, not erased. Regional premiums are widening. Open interest is migrating. Exchange disruptions are clustering. Each element has a benign explanation in isolation. Together, they suggest a system under tension. Whether that tension resolves quietly through inventory conversion and premium normalization, or through more visible volatility, remains unknown. But understanding the architecture allows you to interpret events without emotional reaction, and that is strategic advantage. Financial history teaches a consistent lesson. Infrastructure operators always possess structural advantages over participants. That does not make them villains. It makes them system architects. When you understand the architecture, you stop reacting to headlines and start analyzing mechanisms. The vault reports are public. The Shanghai premiums are visible. The open interest data is accessible. Verification is not difficult. It simply requires time and intellectual honesty. If you value this kind of structural analysis, calm, data-driven, historically grounded, subscribe to world finance history, not for predictions, for perspective. Because markets move in cycles, infrastructure evolves, participants change, but the tension between physical reality and financial abstraction has defined commodity markets for centuries, and those who study that tension rarely get surprised by it. Knowledge is not leverage, it is stability. This is world finance history.